Hey, how's it going, everybody? Welcome to Finance with Avern. In this video, I'm going to get into what is inflation, what is deflation, what is stagflation, what causes each one of them, and how to prepare and overcome when they happen. Now, there's going to be some overlap in that section right there of how to prepare and overcome them, because the financial fundamentals I'm going to be teaching in that section are building blocks that can help people regardless of what's going on in the economy. Sometimes when things are happening differently in the economy, some of those fundamentals will be more important than others. However, some of those fundamentals pretty much overlap and will be constant throughout all kinds of economies, basically. And depending on your financial situation, some of them may be more important to you and some may be less important. But regardless, some of these financial fundamentals will help people battle the storm when these different economic environments happen, and also come out of them even better when they happen, after they happen, while they're happening, and just throughout. Sometimes it's harder to prepare for something because sometimes they kind of creep up on you. However, if you're working on things while inflation is going on or while deflation is going on, and then when they kind of subside, things get a little bit more calm, you'll be in an even better financial position. So yes, let's get into it first, starting with inflation. Inflation. What is inflation? Inflation is a rise in prices of goods and services, which also causes a decline in purchasing power over time. When the price of an item rises, that translates into the amount used to buy it increasing, which means it takes more money to buy the same item, regardless of whether or not the person has more or less money. This loss of purchasing power impacts the cost of living for the general public. The economy in America is driven by consumer spending. So when that slows down, that plays a big part of what's going on in the economy. When that speeds up, same thing. The speed of it, the rate of it, all of that is very important of what happens to our economy, what's going on with prices, supply, and demand. Now, there are two main common indexes that measure inflation, and they include and condense data to show the rate of inflation. These two indexes are the Producer Price Index and the Consumer Price Index. The Producer Price Index was formerly known as the Wholesale Price Index, but the BLS, Bureau of Labor Statistics, renamed it to the Producer Price Index because the index never measured price change at the wholesale level. Now, the PPI, Producer Price Index, measures inflation from the point of view of cost to producers of products. This index can show if the cost of producing goods is rising or falling. Since this measures prices before they reach customers, this index can often be seen as an earlier predictor of inflation than CPI. Now, speaking of CPI, which is the Consumer Price Index, it examines the weighted average of prices of a basket of goods and services that are primary consumer needs, which can include transportation, food, and medical care. Changes in the CPI are used to determine price changes associated with the cost of living. So when you hear people referring to the cost of living is rising and things like that, that's going along with the CPI, the Consumer Price Index, because it takes into account things that people pretty much need, what they buy all the time, regardless of what's going on in the economy. People are going to need food. They're going to need medical care. They're going to need transportation to get to their job or to get to school and different things like that. So these are consumer needs. And so when the price goes up on them, it's definitely going to affect a lot of people, because these are things that they have to pretty much do. They have to depend on it. They have to do it. They have to spend their money on these things. So when the price rises too fast or at a certain rate, it's going to affect them. Just like if it slows, it's going to affect them as well. Okay, so now that we know what inflation is, what causes inflation? An increase of the money supply is one of the causes of inflation, but this can be done in multiple ways with various effects. Printing and giving away money via stimuluses, loaning new money through the banking system, and legally devaluing currency are some of the ways that you increase the money supply and the credit supply, because you're easing up things for people. You're, with stimuluses and things like that, you're pretty much just giving people money, and it's like, initiating and increasing spending. Basically, people have more money, people are going to spend more. I mean, that's just some people are going to save more, of course, some people are going to invest more, but a lot of people are going to spend more, So with that increase in the supply of money and credit increases the overall demand of goods and services, which leads to the demand increasing more than the ability to produce those same goods and services. This is that supply and demand. This gap between supply and demand results in higher prices. There can also be increases in prices for the production of goods, which can contribute to the rising consumer prices. A continuous increase in wages can also result in a higher cost of goods and services. So you have various things that can affect the prices of goods and services. You can have too much demand outweighing the supply that you have of these goods and services, which is going to cause the price of those goods and services to rise because they're more in demand. And also producer prices. If the prices to produce something, the cost of something increases, well, the producers of that product, they're going to have to increase how much they're going to sell it to consumers for to make up for that. So you have an increase in prices as well right there. And also, if businesses have to pay their employees more, there's a chance that the business is going to increase whatever their product or service is to make up for that. If they got to pay, a lot of employees more money and they're used to making a certain amount of profits, or they, barely breaking even, no matter what it is, however their financials are going, there's a good chance they're going to increase the prices of what the service or good that they produce to make up for that and account for that. And that's going to spread out. Okay, so I've gone over what is inflation and what causes it. Now let's get into how to prepare and overcome inflation. There are several things you can do to prepare yourself for inflation if you know it's coming, you've seen the headlines, you've seen the research, and these steps can also be very helpful when you're actually dealing with inflation, when you're in the midst of it and you're actually dealing with it day to day, month to month, you've been in it for months, because in 2023, we've definitely dealt with inflation in the United States of America. So these steps are steps that can help you prepare for inflation and overcome it while it's happening and help you come out of it better. Like when inflation cools down, you'll be better equipped financially to have success. So one of the main things you can do to prepare and overcome inflation is to have an emergency savings. A savings account is important to have for emergency purposes and general saving purposes. To maximize your savings, it's great to have a high yield savings account and an online bank account or a traditional bank, just somewhere where you have a high yield. Currently, high yield savings accounts are offering between 4 to 6% APY, annual percentage yield. And I do videos every other month or so ranking the top 10 high yield savings accounts ranked by APY. I'll link it down in the description and you see it right there popping up on the screen. So I have a playlist. You can go back and check those out. And I also do just individual deep dive videos, in detail reviews and overviews of high yield savings accounts. I've done a video on the Markets by Goldman Sachs high yield savings account, the SoFi high yield savings account, Betterment, their cash reserve account, which is similar to a high yield savings account, UFB Direct high yield savings account, Wealthfront as well with their cash account that's similar to a high yield savings account. It's kind of like a hybrid of a checking account as well. And I plan on continuing to doing those deep dive videos about high yield savings accounts and other kinds of accounts as well. But yeah, high yield savings account is definitely great to have with an emergency savings, and the higher yield will result in more interest being paid to you. And if you let that sit in your savings as well, then it will compound and increase even more. And to make this even more powerful, try adding to your savings every time you get paid, every month, every other week or so, or whenever you have some extra money that doesn't need to go towards bills or debt or investing. However, if you don't want to just save everything after bills and necessities, you'll want to continue to invest as well, or start if you haven't. And that leads me into the next step. And these aren't in any kind of certain order or anything from most important to least important, or do this first and do this second. These are just in here generally, just any order you want to do these, or do them all at the same time. Definitely just work on them throughout the year, throughout the month. Just definitely be a great way to do this. And so with investing, you definitely want to have a diversified investment portfolio. You can either do this through investing in individual companies, ETFs, exchange traded funds, or both. You can do this via robo investing, the automatic investing, and platforms like Ally Bank, Wealthfront, and there's more that do this, Betterment, and so on. With these, you just put a certain amount of money in a recurring basis, both chosen by you, and then you let the platform itself invest the money in certain assets depending on your risk profile and how much risk you're willing to accept. So that's more of a hands-off approach. You could do hands-off investing with the robo automatic investing, or you can also pretty much do hands-off investing with investing in ETFs. You can just set a recurring amount, invest $20 a week into this ETF and $20 a week into that ETF, or so on and so on. Just a few good solid ETFs with low fees associated with them, and just let it compound and let it grow. And that's a really good hands-off way to invest and be diversified in your portfolio. And typically that's a good way of making gains. When you do a lot of in and out trading of individual stocks and ETFs, there's a time you can lose money. You can get emotional, things like that. People do sell when the stocks are down, and then they buy them when they're high and the hype is there and everything. So if you're susceptible to that and falling into the emotions of stock market, and investing and trading is definitely to be more hands-off. You could do both. You could be hands-on in one portfolio and hands-off in another portfolio. That's kind of how I am. I'm more hands-on in my individual taxable account, and I'm more hands-off in my Roth IRA. I just pretty much invested ETFs in that one. So it's just anyway, but definitely have a diversified investment portfolio is a great way to prepare for and overcome inflation. Typically, more risk equals more reward, but you definitely don't need to be really risky in the stock market to make money. The stock market is more of a long-term game of consistency. So as long as you continue investing and for the long term and hold for the long term, you'll typically make a nice amount of money based on statistics and history. For example, the S&P 500 on average makes around 9%, which you can expose yourself to via ETFs like SPY or VOO. And that 9% right there is more than the current rate of inflation. So for that example, the money you're putting to work is beating inflation. History has shown that the stock market is making around those gains, and you can see the history of ETFs and the information on the websites and the prospectus and everything, and kind of see how the ETFs has performed, the past year, the past 5 years, the past 10 years. It's good to look at a long term just to kind of see, because there's definitely going to be a down year. Like last year, there were some rough moments of last year. If you look at another year, it could be a rough moments, but spread it out even further, zoom out more, 5 year, 10 year, to get a good idea of how the ETF performs. So yeah, that is definitely a great way. And another way to prepare for and overcome inflation is to pay off debt or consolidate it. Inflation sometimes happens during and around the time of rising interest rates. When the cost to borrow rises, this can affect debt with variable rates. And a lot of debt is linked to variable rates. Credit card, APRs, annual percentage rates, they are linked to a variable amount. So they can rise and go down. They're not fixed typically. So you can have a rate, of 17 something percent, and that debt is piling up with inflation going up. And then all of a sudden that rate is 20 something percent. And that's going to add on and add on more. If you don't pay off that amount in the credit card every statement period, well, that's interest going to be working against you. Compound interest can work against you or can work for you. When you're saving, when you're investing, that can work for you with compound interest. When you have debt on a credit card or some kind of loan or something, and you're not paying it off on time, that could be compound interest working against you, because there's going to be more interest charged towards you every month, just piling up. And another thing you want to do to prepare for and overcome inflation is to hold off on big purchases that you need to borrow for. As I was just mentioning, in an economy with inflation, the cost to borrow can also be higher than normal and possibly continue to increase. If you have to borrow to pay for something in this environment, then you'll be stuck with a high interest rate on that purchase once the environment changes and interest rates fall. If it's a fixed rate, then it's just going to be locked in at that high rate no matter what's going on in the economy. Sometimes there are ways to get out of that, like with refinancing, but that comes with a cost as well. If you have to or definitely need to make a purchase that requires a loan, then of course you have to. But keep that info in mind if something's not necessary or you're on the fence about a purchase. Now that wraps up my section on inflation. Now it's time to go over deflation. Deflation. What is deflation? Now, deflation is the general decline in the prices of goods and services. Outwards, deflation benefits customers because they can purchase more goods and services with the same nominal income over time. Now, nominal income is income that hasn't been adjusted for increasing or decreasing purchasing power. On another side, deflation can impact borrowers negatively because they could have to pay their debts with money that is worth more than the rate at which they borrowed. Now, deflation can affect you and I positively or negatively depending on our financial situation. And another way to realize what deflation is that deflation is when the inflation rate falls below 0%. Now, what causes deflation? Deflation is typically associated with a decrease in the supply of money and credit. However, prices of goods and services can also fall due to increased productivity, competition, and technological improvements. A decline in aggregate demand can also result in lower prices. Deflation can also be caused by consumers' desire to increase savings, tightening monetary policies, reduce government spending, and stock market failure. Now, the most dramatic period of deflation in United States history took place between 1930 and 1933 during the Great Depression. The most recent happening of somewhat major deflation occurred around 2008 during the Great Recession. There was also a very minor deflationary dip in CPI in 2015, but not that notable compared to previous times of deflation. So deflation and inflation kind of go hand in hand. They're not the same, of course, definitely, but the things that measure inflation can also be used to measure deflation. And some of the things that cause inflation are opposites of things that cause deflation. Now that I've gone over what is deflation and what causes it, let's get into how to prepare for and overcome deflation. With deflation, a decline in prices of goods and services across the economy might seem like good news after dealing with high prices for so long with inflation. However, deflation is typically accompanied by job loss, lower wages, poor investment return, and other negative side effects. Although deflation and inflation are different in several ways, there are similarities in how to prepare for them and overcome them. Now, you want to, of course, build an emergency savings. It's always great to have an emergency savings in basically any kind of economic environment. Sometimes it's just somewhat more crucial than others. With deflation, sometimes being accompanied by job loss, having an emergency savings can be a major help if that job loss happens to you. And of course, when having a savings account, you want to have that high yield savings account, which I discussed in the inflation section. So check out the section on how to prepare for and overcome inflation to learn more about the high yield savings accounts. And I have several videos on my channels about them as well and why they're important to have. For example, I have a video titled 5 Reasons to Have a High Yield Savings Account, and I'll link that video down in the description. Now, with deflation, you definitely want to pay off and or consolidate debt. In a deflation environment, wages may fall, which can make it harder to pay off loans. If you get ahead of this before the negative impacts of deflation, that can be a great help. And I won't expand on that more because I talked about the importance of tackling debt in the inflation section as well. So definitely check out that section for more info on that if you missed it or if you want a refresher. Now, with deflation, it may sound like a lot of things you need to stop doing or, other things you need to be doing, savings, and stop doing this and that. But one thing you want to do for sure is continue to invest. So continue to invest, but be more picky if you're investing in individual stocks. Companies with strong brands, pricing power, and good balance sheets are the safest bets because they'll be better positioned to withstand an extended economic slowdown. And also companies with all of those things and as well an international presence could be safe bets as well because deflation typically doesn't involve like every country, or every major country. Different countries can go through these economic periods of deflation and inflation themselves or be worse off than other countries. So a company with some exposure internationally can benefit from having, things going better in that country than in just the United States or vice versa. Having a diversified investment portfolio will be helpful as well because certain sectors may fare better than others, which can somewhat help balance your portfolio and lead to possible gains or less dramatic losses. Also, it's important to continue investing and not panic sell. Some of the best times to buy stocks and ETFs often happen in rough economic environments because prices can be depleted too much and cause some securities to be undervalued. And I talk about that often in my investment videos about those are some of my favorite times to buy. I made a video on the fear and greed index and talking about it and how I use it to purchase stocks sometimes. So when there's rough economic times going on, those are some of my favorite times to buy stocks. I try to kind of keep some money saved up on the side, but I'm always like, oh man, I wish I could have bought more of that. I wish I could have bought more of that. And I buy as much as I can, but it's always like that. I wish I could have bought more. And the thing is like, I'm definitely increasing my buying during those rough economic times. It's just that there's so many stocks on sale during those economic rough times right there. So yeah, it's definitely good to have either increasing your positions in stocks and ETFs that you already have that you like that have been doing well, and also good to have a watch list of certain stocks and ETFs that you want to add but may seem a little bit overvalued at the time because when these rough economic times happen, it's a good time to start a position sometimes in some of these strong companies and ETFs. Now that I've gone over deflation, let's get into stagflation. Stagflation is characterized by high unemployment, slow economic growth, and inflation. This is one of the most difficult economic conditions to be in because when the government tries to fix one of those problems, it can negatively affect another. Stagflation isn't measured by a single data point, but instead is measured by examining the direction of various indicators over a period of time. So stagflation, as you see on the screen, is not just one thing, not just two things. Typically with stagflation, it's a combination of three things: high unemployment, slow economic growth, and inflation. That's why I put the plus marks in between those points right there, because it is a combination of those things, all those things happening at once. They don't have to happen at the same exact time, but it can start off with high unemployment and slow economic growth, and then inflation happens, or start with slow economic growth and then inflation and then high unemployment. As long as they're all going on at the same time at some point, then you have stagflation. Now, what causes stagflation? There is no exact consensus on what can cause all of the situations behind stagflation to go on at the same time. However, different situations can result in high unemployment inflation, and slow economic growth that are unrelated and related to each other. An unexpected event like a shortage of very important components that affect the economy, a pandemic, or a major disruption in oil supply can lead to all the factors that make up stagflation. Stagflation is very rare. The last time it happened in the United States was during the 1970s. It was finally interrupted when the Federal Reserve raised the federal fund rate to 19%, and interest rates got to the point where borrowing was impossible in many segments of the economy. That situation led to two recessions in the following years, and by 1984, tens of thousands of businesses failed and unemployment rose to as high as 10%. There's no exact consensus on what specifically can cause all of those issues at once, or either have them all happen, within a month or something like that, basically where they're happening at the same time. Like I said, they can start at different times, but having all of them go on and happen at the same time, there's no exact consensus on what specifically can cause that all at once. And also with some of the issues that can lead to stagflation, those issues could be caused by incompetent economic policies. Now that I've gone over what is stagflation and what causes it, let's get into how to prepare for and overcome stagflation. With stagflation, you want to delay large purchases if that area is experiencing trouble, like some sort of bubble. Examples of this could include some sort of housing crisis or a bubble that causes sharp rises in bloated listing prices. Another large purchase area that could be affected are automobiles. If there's some sort of supply disruption that affects the auto industry, that could cause substantial price increases and delays. Like with semiconductors, we had an issue with that a couple years ago where there were disruption of semiconductors, and that's in all kind of products. It's definitely in cars, with the cars becoming more electronic and not just EVs, like electronic vehicles. The legacy autos with the regular engines and gas and everything, they have semiconductors in them as well that control all kind of various components. So that's a situation that could lead to, and has led to, automobile prices being bloated and delays in automobiles being delivered. And so some of these building blocks and tools, like I stated with the deflation section, are also in the inflation section and deflation section, and vice versa and so on, because many of these tools and fundamentals for your personal finances will help you in various ways in different kinds of economic conditions. So it's very important to have these building blocks in place and work on them throughout, before we get into these situations in the economy, while we're in these situations in the economy, after these situations in the economy, and so on and so on. Now, another way to prepare for and overcome stagflation is to pay down debt and improve your credit score. If your emergency savings is depleted, or if you need a loan for some reason, having a great credit score will help you get approved for one and help you get the best rates available. And in general, paying down debt will help you have a more stable financial future, no matter which way the economy goes. And so with stagflation, you definitely want to continue to invest, but make sure you're diversified. If your investment portfolio is too risky or concentrated in an area that's being affected in the economy, you could experience losses more substantial than you would if you were more diversified. This could also lead you wanting to sell, which is also typically advised against, but instead patience can be rewarding because the market overall tends to rebound after crisis and sometimes does sharply. So you want to definitely be patient, not panic sell, hold on to the great investments, add more to those great investments, and be patient, because typically what history has shown, these market rebounds after these economic conditions, these economic crises, and these rough economic times. And sometimes that rebound is so sharp that you can miss it. You sell all or most of your investments during the bottom, and then you try to jump back in and try to time it or something where you've jumped in at prices that are higher than what you sold it for. And, so you're selling low and buying high. That's not what you want to do in the stock market. And also with stagflation, you want to reduce spending, live within your means, and make sure your emergency savings is sufficient. A good rule is to try to have 3 to 6 months worth of living expenses in your savings. If you need help with this and or paying down debt, look into finding additional sources of income, which can include a part-time job, side hustles, gig work, selling things you no longer need or want, monetizing something you're good at, and more. You can definitely find out more info about these on YouTube in various articles. Just, type in Google search or something, side hustles, gig work, selling, monetizing, just different things like that. Some of the information out there is great. Some of the information out there is kind of You probably have a good judgment of character where you could find out, you kind of do some research and kind of tell like, oh, okay, this seems too risky, or this seems kind of like a scam or something. this seems more sufficient. I actually know people doing this. I actually see people doing this, making money from this, and so on and so on. So yeah. And also, stagflation is characterized with low employment. So this will help you if you find yourself among those employed. Having that additional income on the side is great when you're employed fully. And then also, if something happened to your full-time job where you're no longer employed there, you're kind of in between finding a full-time job. And sometimes that employment on the side can become as much as you were making at that full-time job. And so you have like two incomes for one person, basically. So yeah, that could be great if you're still employed full-time, you're just in between jobs. And then also when you pick up another job, keeping that income on the side rolling in every month or so, it's definitely a great thing to have. Now, these are great personal finance goals, and having these things in place can help you weather an economy that's both stagnant and inflationary. And that is it with my video, what deflation, inflation, deflation, stagflation, what are they, what causes them, and how to prepare for and overcome them. Hope you all enjoyed the video and found it informative and educational. Thanks for watching. Take care.